Good morning and thanks so much for tuning in to the Trade Setup. I'm Niraj Shah, and today's Trade Setup is not as much about how I'm seeing things as much as it is about getting a really experienced global voice to try and tell us his thoughts on how he's piecing together the various pieces of the puzzle. Geoffrey Dennis needs no introduction really. Now, I mean, for some time now, an independent emerging market commentator, but eyes everything on the globe with equal gusto, joins us right now, late evening from the US. Geoffrey, good having you. Thanks for joining in. Hope all is safe.
Yes, thank you very much.
Okay, Geoffrey, tell us, the Indian investor, the average Indian investor is worried with the noise around the rising yields, what it could do to rates, if you will, and geopolitics as well, with the whole Israel-Iran issue and the Taiwan-Chinese issue as well. What do you think is spooking the markets? Because emerging markets, including India, have slipped nearly 5-6% from the recent highs.
Yeah. I think that the specific moves on Monday have more to do with events in China, and maybe we'll discuss those individually. But the general move is profit taking and pullback in markets. It's got everything to do with the rise in US bond yields and the rise, the concerns about rising inflation, and what that could mean in terms of the timing of any move by the Federal Reserve to either raise interest rates or reduce some of the quantitative easing. Now, I've argued all the way along that rising yields are the biggest threat to the US stock market, because one of the reasons why people are willing to hold this market at these very high valuations is because the cost of capital is so low. In addition, I think it's worth pointing out that this extraordinary amount of fiscal expansion in the US, and of course they're working on another $1.9 trillion of fiscal expansion, which is very fashionable now to say on the left wing, sort of liberal wing of the Democratic Party, is okay because yields are so low. Well, to me, that only works while yields are low. If yields were to rise sharply, this fiscal expansion becomes a big problem for the US in my view, because it raises debt servicing costs. So I think equities are watching over the last 4 to 6 weeks the rise in bond yields, which could very well go further in the short term. Although I think the real key about today was specific events in Brazil and China. I should say today, meaning Monday.
So how worrying are those events, Geoffrey? And part two, I mean, specific to China and Brazil, as you said, and anything on the geopolitical front that worries you at all?
No, I don't think there's anything particularly concerning on the geopolitical front. Obviously, we have to watch tensions in the Middle East because of the potential impact on oil prices. That's pretty standard. But I don't see the tensions in the Middle East being that much different today than they were, say, a few months ago. Indeed, on the contrary, I think President Biden may very well try to persuade Iran to come back to the deal that the US so shockingly walked away from under President Trump. The way I'm looking at it is the Brazilian situation very specific. The firing of the Petrobras CEO, which is going to lead to much more government intervention in the pricing of gasoline within the economy. Petrobras shares were down 20% in New York today. China's a bit broader because it really came from further restrictions on online lending, which are going to impact the Ant Financial Group and therefore Alibaba. So I think this really helped to precipitate the tech sell-off today globally. I think that is something to be more broadly concerned about. And really, we have to see the NASDAQ stabilize before people are going to start to want to buy stocks generally. But I'm not sure I see anything really specific about geopolitics to worry about. Now, obviously, you mentioned at the beginning China and Taiwan. Now, were things to get sort of nasty between China and Taiwan, clearly this would be a major geopolitical event. But so far, it's just bubbling under the surface rather than being something I think the markets are reacting to.
Okay. Geoffrey, the popular narrative all this while has been that the Fed has said that even if yields were to rise, they are not going to move on rates until better part of 2022 or 23. So that one, and two, this massive 1.9 trillion stimulus will, whenever it gets announced and eventually gets accentuated, will act as a backstop for any large corrections in equity markets. Now, my question to you is, do you reckon that this recent correction that we've seen is a normal large correction, or can it deepen?
I think that I doubt the correction goes much further, frankly. I just don't think it's going to go much further, because I think there's a lot of support for equities, even at this level of bond yields. But I think I think you're right, of course. It's going to take a while before short-term rates start to rise in the US, and maybe they're going to rise a bit earlier than previously expected, maybe late 2022, not 2023. That's a long, long way away, frankly, as far as I'm concerned. But the thing I worry about is if the bond yields continue to move sharply higher, let's say for the sake of argument, they go to 2% by the middle of the year, that is going to have a tremendous impact on debt servicing costs. And it's that, I think, that concerns me, the steepening of the yield curve, as much as the short-term moves towards, the moves towards higher short-term interest rates, which I'm sure are very far down the road. So I think what people are going to focus on with respect to Chairman Powell is not what he's going to say on short rates, but what he could say on potentially tapering the $120 billion of QE that the Fed is doing every month. That's, I think, what the market is going to focus on.
Okay, Geoffrey, one quick word on India. I don't know how closely you've looked at the Indian developments of late, but we've had the budget event, which really brought out the best in investor sentiment, if you will. Yeah. And we don't have these issues, right, of a Petrobras happening or lending issues that have now started to crop up with targeting a particular company in China, for example. Does all of that keep India in a good stead?
Yes, I think so. I mean, I argued for quite a while that India wasn't really quite as defensive as it typically has been. You've, of course, had to deal with a shockingly weak GDP number in 2020, or perhaps I should say in your terms, fiscal 2021. Now we're probably going to be coming out of that. With the short-term pressure on China, I think China probably stabilizes before too long. And as long as inflation doesn't run out of control in India, and there's no reason why it should do, obviously higher oil prices are a bit of concern. I do think India looks a little bit better positioned than it may have been 2 or 3 months ago, because as you rightly say, it doesn't have any of these individual, Brazil-China issues that cropped up today. I guess the foreign investors very, very tuned in to the protests by the farmers on the agricultural reform package. And I think there needs to be some resolution of that to really encourage investors to go back in. But inflation looks under control. The economy is going to recover. Okay, the market's expensive, but then India's pretty much always expensive. And the currency is pretty solid. So I think the event risk in India is probably limited, but people would like to see these protests by the farmers begin to subside and this whole issue get resolved on agricultural reform.
Geoffrey, really appreciate you taking this time out. And it's been a while talking to you, but we look forward to talking to you more as the global developments emerge.
Great. Thank you very much.
Thank you. Have a good evening.
Thank you.
Well, that's one of the most astute voices that I have heard in my 15, 16 years of career, sitting abroad, but looking at emerging markets in general. Geoffrey Dennis, now an independent emerging markets commentator. Okay, just a quick segue into India, therefore. We've heard the global opinion now. Let's wait and watch what happens to yields and how much does that spook investors and valuation multiples. Now, back to India. What should you watch out for? Well, just very quickly, keep in mind that the Nifty broke the 20 EMA in the worst drop of February. And according to technical expert notes that I read, 14,550 and 14,470 now become a key support. But as I said yesterday, everybody was touting about how 15,000 levels become a base because of the put writing. Look how it just got taken away. And therefore, yes, these levels are supports, but who knows? And keep in mind, volatility is extremely high. India VIX yesterday shot up 15%, if I'm not wrong, and it's extremely high. It's expiry week, so you expect volatile behavior to stay for Indian markets in the session for this week for sure. This is CBOE VIX, but India VIX individually really shot up in trade yesterday. However, what about individual stocks? We've discussed markets at length. We are likely to start off maybe marginally lower or thereabouts because US futures are at best just steady. They are not really gung-ho. The US markets are trying to stabilize themselves. NASDAQ has to improve. In light of all of that, the SGX Nifty might be pointing towards a weakish start. Even if it is not, I think people would want to believe that unless the markets show a definitive Q upwards, you don't want to go out and really do big bang buying. So about, well, 90 odd points in the green. Well, that's good news. Let's wait and watch if this lasts. What about individual stocks? As I said, Hindalco is an important one. They're targeting a 2.9 billion reduction in the debt load between June 2020 and end of 2022. The company is also envisaged a new dividend policy with a payout of 8 to 10% of the consolidated free cash flow. Now, MK is sounding very pleased on the new dividend policy. Debt reduction is always welcome, right? So that's good news. MK is saying that the new dividend policy is a major step taken in terms of rewarding shareholders as Novelis continues to throw record operating cash flow. And they expect that the strong free cash flow from FY22 onwards and 8% of the FCF would actually result in the dividend per share increasing from the current 1 to 1.2 rupees per share to 4 rupees per share. That's extremely positive from a large institutional investors' perspective. So let's wait and watch. Hindalco could be a very important stock to watch. Zuari Agro, they're going to sell the fertilizer plant in Goa and associated businesses to Paradeep Phosphates for an EV of $280 million. So that's pretty interesting. InfoEdge, the stock tanked 10% yesterday. Now, Zomato has closed the primary fundraise of $250 million from 5 different investors. Let's see if this brings about a bit of a spurt into InfoEdge or no. And while large cap IT tanked and NASDAQ was looking weak, mid cap IT had a different breed altogether yesterday. Sonata Software, Zensa Tech, Emphasis, all of these were up and about in trade yesterday. So I'll be keeping a keen eye out on mid-cap IT stocks in the session today as well, even if large-cap IT were to correct. Though I do think that large-cap IT has done its bit of a correction, and there might be some stability in the near term. This is, of course, provided NASDAQ stops falling, so you've got to keep that in mind. MOTILAL has come out with a note on BPCL. They have upgraded the stock to a buy with a target price of 520 rupees per share. They raised the valuation multiple to 2.1x from 1.7x FY23 basis. They believe that the recent steps taken by the government and the company on divestment of its larger subsidiaries and the JVs is a key trigger for their valuation multiple upgrade. The efforts on rationalizing employee headcount is encouraging, and they've become optimistic on the future prospects of the divestment. I think the note effectively says that because divestment is moving up ahead, they are turning positive. Keep in mind, viewers, the other thing also would be Reliance Industries because of their O2C project announcements that they have done. It should be positive in the long term. I don't know if it's got short-term implication. Really, I don't think it does. So I don't expect Reliance to really react too much. And last but not the least, viewers, very quickly in this very long trade setup, what stood out for me is that while oil is moving up, Goldman, etc., everybody has raised the target prices for oil. And if Middle Eastern tensions fructify, then it would be bad news for oil prices. I think they will move up. But on the Bloomberg terminal, there's this chart which the 14-day RSI is hit the highest level since 1990. It's the strongest sell signal for crude in 30 years. Pretty interesting to see how crude fares in light of all of this that's happening. So lots to monitor, and that's why I said that the markets will be volatile. Please keep your stop losses in place. Trade safe. Have a great day ahead, and please wear your masks. Thanks so much for tuning in.